discuss the taxation of Social Security benefits and a key concern that can be extremely costly if you don't understand how the taxation of Social Security works. This is a concern known as the Social Security Tax Torpedo. Now, to illustrate this, I'm going to take you through an example using this tax brain teaser. So after working hard for her adult life, Sue, 65, has finally retired, and she's going to be going to more concerts than ever before. Sue has $46,138 in taxable income, which includes $37,500 of Social Security benefits this year. And as you can see, Sue's $46,138 of taxable income puts her in the 22% tax bracket because it's more than $44,726 and less than $95,375. Now, towards the end of the year, Sue decides that she's going to take an extra $1,000 out of her IRA because she's going to take a trip to see Taylor Swift with her granddaughter. How much is she taxed on that extra $1,000? Now, the logical answer is that for every dollar of IRA money that she pulls out, she's going to pay 22 cents in federal income taxes. Therefore, if she took out $1,000, she should owe $220 in federal income tax, 22% tax. So simple enough, right? Wrong. She owes $407 in tax, a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how Social Security benefits are taxed, the real answer is that Sue owes $407 on that extra income. Now, to understand what happened, we need to understand a concept known as provisional income. First, know that as little as 0% to as much as 85% of your Social Security benefit can be included in your taxable income. And that percentage for you is going to be based on what is called provisional income. Now, you can see on your screen what goes into calculating this amount. It's going to include your adjusted gross income, or your AGI, which is going to include income such as pension benefits, employment income or business income, and IRA distributions. Even the interest that you earn on savings and CDs and money markets. Now, as you can also see, you also actually add back in tax-exempt interest that you might earn on municipal bonds, or what we thought was tax-free income sources. But to calculate provisional income, you actually have to add tax-exempt interest back into the calculation. Where tax-exempt interest gets added back in, Roth IRA distributions are not counted. And this is where retirement income timing really becomes crucial in minimizing the tax implications on your Social Security as well as your other retirement income sources. Now, let's go back to our example to see what happened to Sue. So we want to understand why she paid such a high tax rate on that extra money that she took out of the IRA to go to that concert. Now, again, remember, Sue has $38,000 of IRA income, part of her adjusted gross income of $61,838, and she has that $37,500 of Social Security benefits. So that puts her squarely in the 22% tax bracket, and she takes the standard deduction. Yet, when she took that extra $1,000 IRA distribution, she got hit with nearly a 41% marginal tax rate, $407 on that $1,000. So let's break that down and see what actually happened. So first, again, let's remember, the only difference between our two scenarios here is that Sue has taken an additional $1,000 out of her IRA. You see that in that after concert trip column, that now she has $39,000 in IRA income. All right, so we see here by adding that additional $1,000 of actual income, it increased both her AGI and her taxable income by $1,850. That means for every dollar of income that she actually received, she's being taxed $1.85. How is that possible? All right, so here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that is taxable varies. So for instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal tax rate is. So Sue finds herself in this latter scenario. At her current income, after the concert trip, for every dollar that she takes out of her IRA, she not only adds $1 of IRA money to her taxable income, but she must also add an additional 85 cents in taxable Social Security benefits. So here again, you can see our calculation of provisional income. When we're looking at Sue, here is the brackets or the thresholds for a single filer. There you can see where those thresholds fall to result in her paying that extra tax because of taking that extra $1,000 IRA distribution. So if you add that up, that's $1.85 taxable at her 22% tax rate for every additional dollar that she takes out of that IRA. If you do the math on that, it comes out to 40.7 real tax rate on the additional $1,000 in income. That is the so-called Social Security Tax Torpedo. Now understand, it can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason why planning taxes in retirement is so crucial.